Then the next study we did was, again in 2008, Buffett wrote, what are the 3 types of businesses? I think this is the best piece written by him in annual reports. In 2007 annual reports, page 6 and 7, if you go, he has written what kind of companies he likes and what are the traits he looks for in those companies. And he termed it, there are only 3 types of businesses in the world: great, good, gruesome. And these are like 3 savings bank account. A savings bank account where you put your money at a high yield, say 20% interest somebody is giving. So that's a very good return. If you are getting your business earning 20%, it's very good. So that's a good company. It's not a great company. Great company is a company where you put 100 rupees, he gives it 20% first year, second year it gives 25%, third year gives 35%, then 40%, then 50%, 100%, 150%. You look at Nestle. Nestle in 2001-2, it used to earn about 25% return on equity. By the time it was 2011, it was 135%. You go and see how it has improved year after year. That's what makes Nestle a special company. So, rising ROE. So, great and good was very clearly understood. What is a gruesome? The real challenge for the investor in the market is to throw out gruesome businesses. Now, what is gruesome? A bad business. A bad business is a business which actually breaks the capital. If the cost of capital is 10%, it earns 5-6%, or actually it incurs loss. But even that is not a problem, because it could be just a historical thing. It could be misfortune of the business that it is not doing well. But the problem is the management is mandated to grow the business, which is very bad business. So what happens is you are earning 100 crores by deploying, say, 2,000 crores. Now you want to double the profit from 100 crores to 200 crores. What do you need? Another 2,000 crores. To earn 100 crores, you need 2,000 crores more. So it becomes a bottomless pit of capital. And everybody gets sucked in, because these companies are available very cheap. And most of the retail guys, they get sucked into buying these stocks. And they stay on, because they're not making losses. Return on equity is very low. Valuation is very cheap. What more you want? You're buying cheap. You can't go wrong. But it doesn't make money, because the company itself is not making money. One other thing is, I don't know if anybody knows how much money you make in the market. From a stock, how much money you make finally? You make as much as the company makes. Please understand this. If company is not listed, you start with a crore rupees company and you make 1,000 crores over a period of time. At the end of it, you'll get 1,000 crores, period. So you cannot make more money than what the company makes. People think that they can make more money than what the company makes. And that's why they don't bother about what the company is doing, they bother about what's happening in the stock market. So fundamentally, we have to understand, we have to buy great businesses who are going to make a lot of money, not only now, in next 10 years, 20 years, 30 years, 40 years. And that's what we do. And that's what has, this particular study, if you see, we gave an example of Nestle as the great company, HDFC Bank as a good bank, good company, and I hope there is nobody from Tata's, Tata Tele Maharashtra Limited as the bad company. When I wrote as a bad company, Tata Tele Maharashtra Limited, it was making losses of 60 crores per quarter. Do you know how much losses they are making now? After 7-8 years. They are making very faithfully, every quarter they make a loss of 165 crores per quarter. They have lost about 12, 13, 14,000 crores. They are still losing. And now they want to expand. They want to put another 10, 20,000 crores to expand the losses. And we still have a quotation of 7, 10, 12 rupees because it is called Tata Tele. You can't go wrong buying telecom company from Tata's, isn't it? So you have to be very clear who is going to make money. Just the name doesn't matter. So difference between, in fact, you should pay to the manager for just getting you into the good companies, good and great companies, and keeping you out from the bad company. 99% of the problem in the stock market is because of the bad companies in your portfolio. And they enter your portfolio purely because they are cheap. And then they come and stay permanently and destroy your entire happiness. Then we did the study on dividends. So stock is worth only what you can get out of it. See, don't look at you bought it for 6 months, 1 year, or 3 years, or 4 years. But if you look at the entire journey of the stock, from the birth to the end, actually what you just get the dividend, nothing else. Rest all is buying, selling. And as a minority shareholder, one guy is buying with other, and that keeps going on. But eventually, as a unit, you get only the dividend. Even the owner gets only dividend in the life of the company. So it is said, a cow for her milk, a hen for her eggs, and a stock by heck for her dividends. So dividend is a very core, and this government doesn't understand. I have been going to SEBI, I have been trying to impress upon the government that, boss, don't charge 20% dividend distribution tax. You're killing the cow. You are discouraging the management from declaring the dividends. If you discourage the management to declare the dividends, the value of the company is going to go down. Because by not declaring the dividend, he is going to put in some liquid funds or going to buy something in Chorus, something in Zen. Somewhere they'll do some crazy allocations. If that same money comes to you, you will go and buy some wonderful company. You'll have holidays. And actually, the valuation of the company will be double or triple. Like Infosys, if they are paying out 40% and sitting on to 30,000 crores, if they pay out 80% without impacting the growth of the company, do you think value of the company will be same? It will be more than double. And if Infosys valuation is more than double, the valuation of TCS, Wipro, everything will also go double. Because if Infosys is available at 15p or 20p, you cannot sell Wipro at 30p. No way. There is an anchoring effect. And then if all these big companies are available at 15, 17p multiple, the whole market settles at lower level. So you need the dividend to be very, very powerful. And it is very tough to make these guys understand what it means. But if you go in any annual general meeting, you get, those small shareholders, they are so smart. They ask for only dividends and bonus, nothing else. They don't ask for anything. So dividend is important. If you read this particular paper, you'll realize we have given mathematics of how dividends decide the valuation of the companies. Then we did the study on moat investing, actually more to do with the unique companies. How exactly the companies become unique, and the valuations, they go much higher, significantly higher for the unique companies, because the moats are there and those companies become inevitable. Then 2 years back, we, in the same moats and abnormal profits, what are the sources of abnormal profits? Because what you're looking for, if the amount of money you're going to make in the market is dependent on how much money the company is going to make, then we have to figure out what are the factors which lead to abnormal profit for the companies. Some guys make a lot of money, some guys don't make money at all. Why is it so? Everybody is working hard. All the textile companies, they are working very hard, and yet they incur losses. And then you look at the tech companies, they have wonderful campuses, and they barely work for 8-9 hours, and they make thousands of crores. How is it possible? So how do you identify these kind of companies? Because uncommon profits means abnormal profits in companies is equal to abnormal wealth creation in the stock market. So what are the factors? How do you pick up? So this particular process is understood in this particular study, which is, I think, one of the fabulous studies to pick up companies early in the game. if you want to pick up, because what happens is every company takes 8-10 years before they understand the game, and they establish their products, they have enough customers, and they start growing in the marketplace. It takes 7-8 years, 10 years, most of the time. So when they come out from there and they start making money, at that time nobody knows the story. So how do you pick them young at that point of time? That's the emergency story. So the traits are given there. You can wire it up and figure out. We do every quarter. All the companies which are coming out in that particular category is being faithfully reported on the table, and then our analysts go and check up whether there is any probability of these companies becoming big. Every quarter it happens. So these frameworks help in terms of investment management. Then the last one we did was 100x, the multibaggers. You know how many companies and what it took for them to create wealth of more than 100 times in last 20 years. So Infosys did about 5,000 times. Lupin did about 2,000 times in the last 20 years. Asian Paints maybe 106, 110 times. So all the companies, so you know what it takes to make big wealth. And here, this guy is saying, you need only 3 things. To make big money in the market, you need 3 things. Vision to see them. Because in stock market, what are you doing? You're buying the future. You're not buying the past. It's all about future. You pay 5 lakh crores market cap for a TCS, which makes 20,000 crores. So obviously you're not buying the past or present. You're buying the future. You expect this company to make more than 5 lakh crores in next 5, 7, 10 years. Am I correct? So, you know, you need that vision to say at current price what I am buying, this company is going to make multiple times of this. So in 2003, I was using this particular ratio, and Bharti Telecom was just about broken even, January 2003. And I calculated that in next 5 years, this company is going to make about 28,000 crores profit. And the stock was held for 5,000 crores. The company made 32,000 crores profit. So, you know, you are buying the future. Very rarely you get this opportunity that you can buy what a company is going to make in next 5 years. Say it is going to make 1,000 crores, you can't buy it for 200, 300 crores. But this is the market where you get this. And these ideas, they come once in 6 months, 1 year, 2 years, and when you get them, you must pile on. So, vision to see them, courage to buy them. Should have courage to buy when you see this, because it's all in the head. It is not written anywhere that this company is going to make this much money. And no analyst will write, mind you. All these highly paid analysts, they are not going to write this. Forget it. You have to do it yourself. So you are very lonely in the market at that point of time. In fact, you call up your friend whom you consider as knowledgeate, and he will say you are wasting your time. So literally, your analyst, your friends, nobody will support you. And when nobody supports you, then you should be very sure that you're on the right track. I have gone in 35 years so many times like this. You know, once when I was buying Indian Hotel at 110 rupees, 10 rupees share I'm talking about, which went to become 1,000 rupees, 200 rupees, whatever. So he said, Raamdeo, you must be out of your head to even think about this company. I said, because it requires so much of capital, this, that. I said, very good. I had by that time, actually before asking this, I had already bought more than 1 lakh share. Then I said, Moti, please sell this, because our friend is not agreeing with this. So there is something wrong, we are making some money, let's get out. I put the order at 10:20, by 10:23, the whole thing was taken away. And we came to know that it was bought by Franklin Templeton. And they made all the money. So, you know, whenever you are early in the game, nobody will support you. You have to be convinced about your own thought process. And all these theories, they help you in holding out to the big one. Vision to see them, courage to buy them, and patience to hold them. And the third trait is the most difficult. And the book says that it is rare amongst the men. Sometimes it is found among the women. But there is no women fund manager. You meet only the guys out here. So, patience is very difficult. If you want to do 5,000 times in Infosys, you had to be sitting through 20 years with Infosys. Then only you can make 5,000 times. And there are guys who are there with the 5,000. I think driver of Narayan Murthy, he is still holding out. So he is the one guy who is the smartest. So, it is not the amount of money you put in the market. It is the amount of time you have spent on the stock. Because power of compounding can work only over a period of time. So, as these stories were on in last 20 years, somewhere when we did, this study, I think it was just 2 years before that I wrote that now it looks that we have some kind of a process, what works. Because for 20 years we are searching that because if there are a million guys in the market, there are a million ways of making money. And we said, this is our way of making money. So we wrote QGLP as our process. And then we started examining ourselves critically whether we are on the right track. And in the last 2-3 years, we have realized that it is not the QGLP that is important, it is how much intensity you bring in practicing QGLP. So QGLP will remain QGLP, but what will go behind understanding quality of business, quality of management, growth, longevity of growth and quality, and what price you pay finally. So this mix of 4 things, there is no 6th parameter in investing. Good business, good management, growth, longevity of the franchise, and all this at what price you are buying. So you have to interplay of all these 5 variables. You have to arrive at and put in the portfolio. So this was the 20-30 years of committing a lot of mistakes on the way, lots of mistakes, and then learning that this is the right way. So we have arrived at this particular thing, and we have practiced in our portfolios. So for last 12 years, we have been managing value strategy that is a flagship PMS portfolio. The strategy has driven almost 20 times, 19.5 times in last 20 years, with almost 27-28% compounded return after fees, against the index of about 19% or something. So 8 times for the index, which itself is fantastic, and 19-20x for the strategy. The same thing more recently, in last 1 year, more rigorously has been applied in our mutual fund products, F25, 30, 35. So 35 is 1 year old now, and it has given us about 65-70% return. See what happens. You see the blue and red. You start just 12 months back, slowly it starts diverging. The quality QGL stocks, they start building up month by month, week by week. So it's good for short term, it's good for mid term, it's good for long term. I hope this journey continues like this for all of the investors in these portfolios. And wealth creation studies and the journey will never complete. As it is said, the woods are lovely, dark and deep. This is for the retirement. But I have promised to keep, that we'll keep performing, and miles to go before we sleep. So I think this journey will continue of QGLP and practicing and bringing more rigor. And will be great if all the clients and all the friends, they join in this journey, not only in terms of investing, but also in terms of contributing what are the better ideas, from the portfolios, and suggesting that they know that this company is better and align in the journey. So that will be very good, and we are all together. All the money is, whatever I have earned or whatever company has earned is also in the same strategies. There is nothing beyond house, not in this portfolio. We don't buy any individual stocks now. We buy only our own products. So alignment is total. So the journey is now, the clients and us, we are in the same boat. If anything happens, either way, we are all together. So thank you very much for patient listening, and I hope